Welcome back to Mostly Growth, where apparently I have taken over intro duties today.
You have. Get used to it.
What do I say? The number one podcast for product monetization. Did I do you right, Kyle?
You got it great. And you know what, CJ? We're shaking things up because today is our 50th episode.
That's a lot of time spent together on the mic.
That is a lot of time Ben has spent editing to make us sound smart.
Whatever you've listened to, it's twice as much Ben has had to listen to and then cut half of. I want to talk about something that's near and dear to my heart. And you may not know why I'm so crazed about this.
Well, and that is the, we should say, the revenue multiple, which is CJ's favorite conversation at dinner, at coffee, when he wakes up in the morning at 2 a.m.
Yeah, my son's middle name is Revenue. I talk about revenue multiples every Sunday in my newsletter. I cover them like a crazy person. I look at them every single week to see what the top 10 are, what the median is across the 144 companies I cover, what the trends are by sector, who the top 3 are by industry. And it's something that I've remained close to because I started as a valuation associate at a private equity firm. And then when I went over to the operator side, I was the one building the pitch decks and also helping us shape the story around what our comp set was. So it's always been something that has helped me in my career around storytelling.
But your view is that the revenue multiple is dead, or it should be dead very soon. And we're going to talk about why and what replaces it. But I think I kind of wanted to illustrate this point for listeners and for myself, because I'm just way less deep on this. Let's get into a couple of example companies and go through what the current revenue multiple they're trading for right now is.
And for context, we're going to use the NTM revenue multiple, which is the next 12 months. So you're taking the enterprise value and you're dividing it by the consensus forecasts that the analysts have and put out there for what they think the company is going to do in revenue over the next rolling year.
We've talked a lot about Figma on this podcast. What's Figma's revenue multiple?
Figma is trading at 7.9, so 8x forward revenue.
What about Salesforce?
4.1.
HubSpot, where are they?
3.3.
That's getting low. Let's get into some of these companies that people think could be vibe coded. How about Asana?
Oh, dude, why'd you have to do that? I was having a good day. 1.6.
And then Sprout Social.
0.6.
0.6?
For less than cash in their balance sheet. That's real bad.
But let's get on to more of maybe a positive side. What about Cloudflare?
Ooh, 27.
And the final one, Palantir.
49x forward revenue.
So revenue multiples anywhere from 0.6 to 49x. There's almost 100x difference between software companies on the public market, which means that there's a lot of nuance here and a lot of other ways people think about valuations. It's not a tight band where you could be oh, companies are anywhere from 3 to 10x. The band is 0.6 to 50.
In the median across the 144 that I track, it's sitting at 3.1, which is the lowest it's been in 8 years, which is crazy. And the top 10 median, so if you take the 10 that are performing the best, it's 13.5x. It's crazy to think the bifurcation between what is just the median versus what is the top 10 median. And the top 10 median is also trading down, but it's more than 4x higher than what the median is.
We got addicted to this idea of SaaS companies as valuable and valued on the basis of, revenue for the most part. They were generally growing, had path to positive cash flow. We kind of thought they would be treated similarly. Now we're seeing huge differences across companies, maybe because people think Cloud Code is going to go kill a bunch of companies overnight, and maybe for other reasons. But what's been causing this death of the revenue multiple?
So, by the way, I want to put a disclaimer that I was one of the people very addicted to revenue multiple. So recovering revenue multiple addict here. The majority of times that I've been negotiating either a fundraise or any sort of liquidity event, it was around revenue multiples. It was not around EBITDA multiples. And traditionally, revenue multiples were reserved for only fast-growing, high gross margin, highly retentive companies that were not yet profitable. The basic principle is that the value of any business is the net present value of its future cash flows, right? That's what they teach you in Finance 101. So the only reason that investors pay ARR multiples for businesses or revenue multiples is that they don't generate cash flow today, but we think the margins are going to be strong, as demonstrated by the gross margin, and eventually it'll make sense to stop pouring money into the growth engine, and we can run this for cash. But there's been a lot of uncertainty around will those companies who are not profitable today ever be able to get there and reliably preserve those cash flows with everything that's happening with AI?
So for the last 20 years, SaaS companies have been growth companies or seen as growth assets. Now they're just seen as a part of the economy and like they shouldn't probably be treated any differently than everyone else.
You have what I call like the terminal value conundrum. So we're going to talk through what a discounted cash flow statement is. And in that, a large bulk of the value, like 70 to 80%, relies on this terminal value that you calculate. And so there's been questions about, in the out years, will this company still be around in 5 to 10 years where a lot of that value is after they become profitable? The market today has even been discounting the current earnings of a lot of companies. So if you think of like a PayPal, the market's basically saying like, F your earnings. We don't even think if you produce $10 today, we're going to discount your $10 today to $6. So it's not even a future thing. They're getting whacked today.
Well, okay, so walk me through like how these calculations work. Like what does this net present value calculation include? The more public math, the better. No, I'm kidding. The walk me through it as if I don't know finance terms.
All right. So everything is predicated on a starting point of the risk-free rate. So think of this, Kyle, as the return that an investor can generate with no risk. So traditionally, we've used the US 10-year treasury. Fingers crossed if we as a country are still a going concern in 10 years, TBD. That's where you can get 4% to 5% depending on the month. You lock up your money for 10 years. You get a T-bill from the government, which is you're buying up the debt and you get 4 or 5% annualized.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
If you run go-to-market, you already know the problem. Your go-to-market data is everywhere. Ads, CRMs, sales calls, marketing, spreadsheets, but you're still guessing what to do next. HockeyStack is the AI platform for modern go-to-market teams that collects all your customer data and unifies it into a single system of action. Then you deploy AI agents that prospect the right accounts, help reps close and upsell deals, improve forecast accuracy, and automate what's already working across sales and marketing. Instead of running 5-year-old processes manually, your go-to-market team finally has agents that understand your ICP, your funnel, and your buying motion, and they execute on it. That's why teams like RingCentral, Outreach, ActiveCampaign, and even Fortune 100 companies rely on HockeyStack to cut through the noise, eliminate wasted spend, and make better go-to-market decisions faster. That's HockeyStack, the AI platform that helps go-to-market teams make space to think and win. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. When your RevRec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. In a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting.
Here's a question. When was the last time you really had time to focus on growth and not chasing contract renewals, tracking shadow IT spend, or explaining rising software costs to the board? Yikes! The truth is, traditional spend management is broken. If you're still piecing together data from 5 different systems just to figure out what you're actually spending, while vendors keep on pushing those auto renewals and price hikes, my friend, I got a solution for you. That's where Tropic comes in. Tropic is an intelligent spend management solution that consolidates your spend data and processes into one unified offering, enabling insights and decisive action. It doesn't just show you where the problems are, it helps you solve them. From spotting hidden optimization opportunities like duplicative spend, to automating those painful procurement workflows, to giving you the best market data that turns every vendor negotiation in your favor. Tropic combines smart insights with real human expertise to keep you ahead of the curve. And I can say firsthand because I've used them for over 2 years. Their SaaS platform helps me with price checks. It helps me keep my calendar organized of when renewals are coming up, and I can actually visualize it. And let me say, it saves me more than 10 hours a week on vendor management, and we've saved a ton on renewals. I'm walking into the boardroom with a lot more confidence. Isn't it time to turn your spend management into your competitive advantage? Visit tropicapp.io/mostlymetrics. That's tropicapp.io/mostlymetrics.
So this is why, for listeners, when valuations skyrocketed in, say, 2021, part of that is interest rates were at historic lows. So the alternative to investing in a growth company was getting like no return on your money. Now there's like an alternative that is actually paying a return.
You nailed it. The risk-free rate was basically zero because the government wasn't going to give you much because they wanted you to invest your money elsewhere. They were pushing you away, actually, from buying up these treasuries to say, go stimulate the economy and invest in something else.
Now you've got your valuation is compared to a risk-free rate of, say, 4 to 5%. And so now how does this impact tech companies' valuations?
Well, so then you have to add in the equity premium. So if you assume the market yields an additional 4 to 5%, you've probably heard, Kyle, people saying, oh, just invest in the S&P, you'll earn 8 to 9% a year. That's how you get to that 9%. So you do the risk-free rate, which is 4 or 5%, plus the equity premium, which is another 4 or 5%. And that's how you get to, call it 9.
Let's go back to this calculation. How does this 9% impact the valuations?
So what I'm going to do is a little flipperoo here, okay? Numerator, denominator. I'm going to do 1 divided by 9%. And what you get to is a 10x to 12x free cash flow multiple as the rational price for a business whose cash flows are stable, but not growing and face no existential threat. And so this last part is really key because there's a lot of existential threat right now. And remember that we weren't even just going off of the free cash flow multiples. Many of these companies were using revenue multiples because they weren't producing any free cash flow yet.
Why did you do the division?
What a rational market would pay for a company on a EBITDA or free cash flow multiple basis. Because we still have to make the trip to what a revenue multiple is. It's simply a shorthand for what you think it's going to produce in free cash flows later. So 10x to 12x free cash flow is the rational multiple on a profits perspective. And the companies that we're talking about, many of them today, we're trading off of a revenue multiple, which is, you could call it another leap of faith on top of what we just went through.
A rational investor is looking at how much profit you're going to make over the coming years, and they're haircutting that based on, the return they can get elsewhere. And we used to maybe just assume, hey, every SaaS company has 80% gross margin at scale, and maybe they can get to X percent, free cash flow profitability as they become big. They could look like Salesforce. But now that part of the shorthand is kind of off the table too.
It is. And I want to explain the DCF valuation model to you in a second because it is core to this entire concept here. But I just want to hit on the gross margins piece because if you're a company that only has 50% gross margin, so that's your revenue less your cost of goods sold, and a lot of these AI companies have a massive cost of goods sold because of the inference costs, it's going to be really hard to get to 20% EBITDA margins eventually, right? But an 80 to 85% gross margin business can probably get there. And you can't use revenue as a proxy for future cash flow without looking at the marginal cost to produce. So that's why I wanted to hit on just like gross margins, very important here. If you don't have high gross margins, the entire revenue multiple argument and proxy or shorthand falls apart.
How would you respond, though, to companies that say, hey, look, yes, maybe our gross margin is lower, but we can use AI internally, which means way less headcount costs. And, if our gross margin's 50%, we could still be 30% EBITDA margins because we're just going to run a hyper lean business.
I would say I would love to see one. I believe it, and that's the promise, but there's even fewer companies who have credibly shown that than companies who have credibly shown we have a high gross margin and we'll eventually get to profitability. Because there are a lot of companies that did get to profitability, like a Snowflake or Salesforce or many of the other pure play software companies that are shooting off 20% more margins, but were once losing.
Investors are looking at maybe more near-term potential profitability based on the existing business. They're not giving a lot of credit for assuming AI is going to make you way more efficient internally. Unless, maybe a block is getting credit for the layoffs because they're kind of signaling that to the market, but they're getting credit more for the layoffs than for like AI productivity gains.
Yeah, they're getting credit for cutting costs out, not necessarily that they've shown any gains yet.
Keep walking us through this. What's next?
So there are 3 ways to value a company. And the first one is a discounted cash flow analysis. And so what you're doing is you're taking the net present value of future cash flows. This is where you forecast out 7 to 10 years, right? You start with today. And then you also end up with this bucket at the end, which is every year after that, which is your terminal value. And so if you're not profitable in those first few years, it's a huge assumption to say that you're going to be profitable in this end state. The investors are feeling more and more skittish that that bucket for terminal value is under siege by AI, and that there's a chance that a lot of these companies won't ever get to this pure cash flowing state that we were once betting upon.
So the terminal values are going down, and it's much more based on how you're doing now and, what you should be doing in the next 5 years.
It's turned into what have you done for me lately? It used to be based on the promise of a future end state in which you could get to 25 to 35% profits, because at the end of the day, the whole reason why investors invest is for the promise of future profits. Now, you could argue that some investors are actually investing so that they can sell to someone else who will bet there are future profits at that point. I call that the next buyer's theorem. What is the next person willing to buy for? But it is all predicated on this idea of making profit. That's why we're in business, to make money eventually.
All right. So this discounted cash flow analysis is meant as it kind of works across any company, right? Public, private, tech, non-tech. And this cascades down to, I think, like a shorthand for this that people often use without doing the detailed analysis is just looking at like comps, like what are other companies trading for?
Yeah, and this is one of my favorite things to do. If you've ever heard a banker saying, oh, we used to spread comps on this company or that, it's coming up with a list of companies that you think you are similar to and using basically their collective DCFs, the outputs from that, to then come up with your own. So it's what are similar companies trading at today? And these comps can be expressed as revenue multiples, EBITDA multiples, free cash flow multiples. So if you're a Salesforce, one of your comps is probably going to be a HubSpot, a Klaviyo. If you're a cybersecurity company like a Darktrace, one of your comparables may be a CrowdStrike, it may be a Datadog, it may be a Palo Alto, but you're coming up with a universe that looks like you to say, well, it's kind of close to that thing over there.
It's just like, hey, if someone's willing to value this other company at a certain amount, like why shouldn't they value me at that amount too?
Right. And if you're private, there will be some sort of discount applied to it. So a discount for your size, right? It's a lot harder to get to a massive scale. The revenue of those companies is theoretically worth more because it's harder to compete with due to their size. And then also a discount for lack of marketability, which means you're still private and you can't freely trade to get in and out of that stock.
For these private companies, without being able to totally just have apples to apples public comps, they often turn to, in my experience, like what have been other relevant transactions in that space.
That's the third one. And honestly, probably the one that's most cited by investment bankers. What they'll do is they'll pull up a list of all the deals in your sector over the last 6 months, 12 months. And the further out you go, the staler it gets. You should roll off the old ones as you continue to do it. But it's what have similar companies actually sold for, which is, I think, a more honest take than the comps, because the comps can fluctuate day to day. The people buying into the stock aren't buying the entire company, right? Precedent transactions, you're buying the entire thing, you're putting your money where your mouth is, and you're taking a control in it. There's also a bit of a bonus to this, because if you buy a company, you have to think through, well, what's the premium for being able to control what it does? And then what's also the strategic value in it? Are there synergies here where it's 1 + 1 = 3?
Looking at these different factors, like what does that mean for what we should be doing today? Like how should we even think about a typical software AI company and how to value them?
You should first know which universe you sit in. If you're a Marcom company, you should not be citing companies in the security space. If you're not a AI first company, you shouldn't be citing companies that are AI native. So it's first like, if it walks like a duck, if it quacks like a duck, it probably isn't a horse. You also want to do a DCF on your own company that is credible, at least internally. And this doesn't have to be like the hardcore banking version. You can probably have a Claude Excel plugin help you do this, but figure out how much of your value is going to be in that terminal value bucket. And if you think investors are going to buy the story, that it has a moat around it. That's kind of the larger picture here. Are the moats eroding around many of these companies that we've said rely on a DCF analysis?
By doing this analysis internally, it would give you much more of an objective sense for like how a vanilla everyday investor would see your business, and also what would be things that you could do differently to improve the valuation of the business.
Yeah, because if you know that there has to be a liquidity event at some point, if you're a venture-backed company, by definition, you are technically always up for sale. A lot of people forget that. So there has to be a liquidity event at some point. Are you going to be judged on a basis of EBITDA? Because I think the bar got really high for any company that thinks they're going to just base any valuation conversation purely on revenue multiples and not have a credible story around profitability.
We talked earlier that the median revenue multiple was around 3x next 12-month revenue, but as we talked about, it ranges from like 0.6 to 50. If we think more about like EBITDA multiple, since we're talking about businesses being valued more on the basis of cash flows and future cash flows, like where is that roughly right now?
So the top 10 is trading at just under 40x forward EBITDA. So the top 10, remember again, it's at 13.5x forward revenue and 39x forward EBITDA. But the overall company is trading at 12.3x forward EBITDA. What's funny is it brings me back to that division we did earlier, 1 divided by 9%. We ended up with something the 12x range. The overall median company is trading 3.1x forward revenue, 12.3x forward EBITDA.
So you think this is kind of rational?
I think it's pretty aggressive for tech companies if you look at the historical basis, because I think there are non-tech companies trading at similar multiples. I think that there are companies that make garage doors that are probably also trading at 10x to 12x forward EBITDA. So a lot of risk is being priced in here. And we say this all the time. This is not an investment show. It's just how we look at the landscape of things from the perspective of an operator. But people are not getting much credit at all for either the profits they have today or the profits that they may theoretically have in the future. So a lot of the SaaS business model is under siege.
Well, let's share some examples. So if the average business right now is being valued at 12x their current profitability, who's on the lowest end? Like they're very profitable, but the market really doesn't care. It is not maybe expecting that profitability will continue.
PayPal, they're shooting off 5 to 6 billion in profits a year, and they're only trading at 6x EBITDA.
All right. So maybe explains why Stripe is thinking about buying them.
Holy shit. Zoom is trading at 2.9x revenue and 6.8x EBITDA. Zoom's a cash machine. Paycom trading at 6.6x forward EBITDA. Upwork 4.8x. DocuSign 2.4x revenue, 7x EBITDA. This has come down a ton. A company that is trading at a very healthy EBITDA multiple will be Tyler Technologies. Have you ever got your assessment in the mail for your property taxes, Kyle?
I have. And I get really annoyed by those because my bank is supposed to just automatically change the amount that I owe them for my mortgage based on the property tax changes, but somehow they like don't figure it out in time. And so it's just such a mess.
Nice. I'll forward your complaint. Tyler Technologies, they're the company that does the assessments. It's like the system of record for all these towns. They're trading at 20x forward EBITDA. So they're a slower grower, highly profitable. Seems like the market doesn't really think that they're going to be disrupted by AI.
Nobody's vibe coding that. If your business is highly at risk of disruption, we're not going to put much of an expectation that even if you're profitable today, that's going to continue in the next 5-10 years. Like we're going to haircut that a lot. But then other companies that are seen as like growth oriented, disruptive, maybe benefiting from the AI wave, they're maybe going to see this huge amount of their valuation tied to the future potential.
Yes. And revenue multiples, I'm joking that they're dead, but they're definitely not dead for the really fast growing AI companies. Now, the gross margin piece, that will be debated over time, but there is a bit of a prisoner's dilemma that I find interesting, because if you are not an AI company and you want to compete to make sure that you're still a going concern, you're going to have to drop your gross margins in order to compete and pay for all the inference to do it. And you're also going to have to bring on a lot of expensive people from outside the company who are uniquely qualified to help you code all this stuff and create the products. But in doing so, it's going to evaporate your EBITDA and free cash flows, right? So do you try to just stay the course of being non-AI but high profits, but then get the shit discounted out of you because you're not AI and maybe you're going to be disrupted and you just wait for that to happen? Or do you go to the well fully and just say, damn the torpedoes, we're going to be super negative free cash flow and go for it, but hey, we'll live to hopefully fight another day.
There really are the two directions, right? It's hard to find a middle ground. Like you're either going and saying, hey, we've got a sticky product. We believe this is durable revenue, but like we're going to get extremely profitable and maintain good metrics. But like if we're going to be valued based on profitability, we're going to get really profitable. And then you've got another kind of group of companies that's going to say, we're a growth oriented company. We have a much bigger vision. We're going to invest like crazy to kind of ride this AI wave and try to be seen as an innovative company again, even if it means some, near-term pain.
Yeah, I think the worst part is to be in the middle, right? Spending like half-ass where you're not going to win the market, but you're also not going to be profitable enough to trade at like a decent valuation. Gearing towards a close, I just want to share this anecdote that my friend who's a growth investor shared with me, Kyle. They usually buy up companies that are doing 10 to 30 million in profits, and they try to grow them to be companies that are doing 50 to 100 million in profits and sell them within 3 years. And so he's talking to this company, it's like tech adjacent, and the founder says to him, oh, well, I would never trade for anything under less than 10x revenue. And he's like, okay, that's kind of funny. He just thinks that revenue multiples are a thing because it's like just what we do. He was digging into it. The guy actually has a company that's 75% profit margins. The guy must be running a newsletter. Maybe he was talking to you, Kyle.
Well, I wouldn't sell that much below 10x revenue multiple either.
But the difference between his revenue multiple and his EBITDA multiple, like there's not a huge gap there, right? So he's essentially saying, I wouldn't trade for anything less than 13.5x EBITDA. That conversation is a lot closer, even though the guy is quoting the wrong lens of what it should trade at. The problem is many of these other companies out there who do not have the benefit of having 75% profit margin businesses, Kyle, it's not going to be a fun conversation when it flips to you can't use a revenue multiple as a shorthand anymore because we don't have credibility in that story. It has to be based on EBITDA. The spread's going to be a lot bigger.
Summarizing some key takeaways for me as more of a lay person, not as in the weeds of this as you are. You can't just kind of blindly trust revenue multiples, and especially the revenue multiples that would have been a thing in 2021 as like a good proxy for valuation. Get more comfortable looking at multiple valuation lenses like discounted cash flows to have a better sense for the current valuation environment. The third thing is, with the discounted cash flow lens, so much of the valuation comes from like what's going to happen in the future and how realistic is that. And so regardless of where you are today, you need a great story about why your revenue is durable and how it's going to be hard for someone else to rip you out.
And if all else fails, figure out what you can adjust that EBITDA to.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Additional production by Steve Sarasoli. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe and give us 5 stars. It only takes like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day.